You check your portfolio. The market is bleeding. You think your Bitcoin is completely decentralized. You think it is untouchable. You believe that because it operates outside the traditional banking system, Wall Street cannot control it. You are wrong. Right now, a single corporate entity holds roughly $45 billion worth of Bitcoin, but they did not buy it all with cash. It is financed by over $16 billion in corporate debt. When you owe Wall Street billions, you are no longer decentralized. You are leverage. And today, I am going to show you exactly how institutions use that massive debt to engineer market crashes and monetize your panic. In the next few minutes, we are going to break down the exact debt loophole that traditional banks use to hijack digital assets. You are going to see the clinical anatomy of the death spiral. You will understand why the 99% always panic sell at the exact bottom, acting as exit liquidity for the 1%. Pause and write this down right now. Debt creates control. If you do not understand how institutional leverage dictates the crypto market, you are playing a rigged game blindfolded. The great illusion of the modern crypto investor is the belief in absolute separation from the system. You buy your digital assets on an exchange. You move them to a cold storage wallet. You sit back and think you have escaped the matrix of fiat currency. You think you are safe, but you are only looking at the retail side of the board. The real game is played with institutional leverage. Let us look at the fundamental difference between how you buy an asset and how a multi-billion-dollar corporation buys it. You take your hard-earned salary, you pay your taxes, and you use the leftover cash to buy a fraction of a coin. You own it outright. There is no debt attached to it, but institutions do not play by those rules. They use a mechanism called convertible senior notes. They go to the exact traditional banks that crypto was created to bypass, and they ask for billions of dollars in loans. They take this borrowed fiat currency and they pump it into the digital asset market. For a while, this looks like a massive victory for everyone. The price skyrockets, retail investors cheer. You see your portfolio double and you think you are a financial genius, but you are ignoring the ticking time bomb sitting on the corporate balance sheet. You are celebrating leverage, not adoption. Debt is a leash. When the market is green, leverage is an incredible multiplier. It makes geniuses out of gamblers. But when the market turns red, that debt requires maintenance. The banks do not care about the future of decentralized finance. They do not care about the blockchain. They are ruthless risk managers. They care about their quarterly margins, their balance sheets, and their collateral. If the price of a digital asset begins to drift downward, the collateral backing those massive loans begins to shrink. When the value of the corporation's holdings drops below a certain threshold, the banks make a phone call. It is called a margin call, and it is the most destructive force in modern finance. The corporation is suddenly trapped in a severe liquidity crisis. They owe billions of dollars to Wall Street, and the asset they use to secure those billions is losing value by the minute. They cannot issue more stock because their share price is collapsing. They cannot borrow more money because their credit is maxed out. They have only one brutal option left. They must liquidate the very asset they swore to hold forever. They are forced to sell, not because the technology failed, not because the long-term thesis changed, but because Wall Street forced their hand. And when a corporation liquidates, they do not sell a few $1,000s like a retail investor. They dump hundreds of millions of dollars onto the open market in a matter of hours. This aggressive high-volume selling crushes the order books. The price drops violently. This triggers what financial insiders clinically refer to as the death spiral. Here is where the math destroys the retail investor. When the massive volume hits the market, the price collapses. But the nightmare does not stop there. As the price drops further, the corporation's remaining holdings are worth even less. Their balance sheet looks even weaker. The banks demand even more collateral to cover the widening gap. So, the corporation is forced to sell even more assets at an even lower price to cover the new margin calls. It is an automated, ruthless cycle of forced liquidation. It feeds on itself. This is not a new tactic. This is the exact same playbook Wall Street used during the housing crisis of 2008. They took a fundamentally necessary asset, real estate, and they poisoned it with excessive leverage. When the leverage collapsed, the retail homeowner was left holding the bag, forced into foreclosure, while the institutions bought back the properties for pennies. Now, they have simply adapted the playbook for the digital age. They are using your belief in decentralization as a blindfold. The digital asset itself has not changed. The code is exactly the same. The fundamental scarcity is intact. But the price is crashing violently because highly leveraged entities are being squeezed by traditional banks. This is the hidden mechanism the 99% never sees. Now look at the other side of the equation. Look at yourself. You are sitting at home, watching the red candles on your screen, trying to find a logical reason for the crash. You read the financial news. You check forums. You look for a fundamental flaw in the technology, a hack, a government ban. You are desperate for an explanation. But there is no fundamental flaw. It is just a massive margin call playing out on a multi-billion-dollar scale. That moment when you check your portfolio and realize the decentralized asset you trusted might be controlled by the very system you tried to escape, that is when the psychological pain hits. And here is the most painful truth of all. Wall Street knows exactly how you will react. They bank on it. When the death spiral begins, the retail investor enters a state of pure panic. You see your portfolio drop 20% in a day, then 30%. The cognitive dissonance kicks in. The fear of losing everything takes over your rational mind. You forget your long-term thesis. You forget the research you did. You hit the sell button. You sell your assets at a massive loss just to stop the bleeding and alleviate the anxiety. You willingly become exit liquidity. This is the exact moment the trap snaps shut. While you are selling in pure panic, who do you think is quietly buying the bottom? The institutions, the smart money. They trigger the squeeze. They force the over-leveraged corporations to liquidate. They watch the retail market panic, sell out of pure emotional exhaustion, and then they quietly sweep up the assets at a massive discount. They use the volatility they engineered to transfer wealth from your digital wallet directly into their institutional balance sheets. They do not hate crypto. They do not fear decentralization. They just love exploiting human psychology. They want your panic. Your emotional reaction is the exact product they are monetizing. They understand that most people cannot stomach a sudden violent drop in net worth, and they rely on your lack of structural understanding to force you out of your position. You cannot change the mechanics of Wall Street. The system is too big, too entrenched, and too well-funded. But you can completely change your psychological response to it. The first step to surviving the crypto trap is to separate the asset from the leverage. Rewind this if needed, because this is how you survive. When the market crashes, you must force your brain to ask one clinical question. Is the fundamental value of this asset broken, or is someone just getting liquidated? 90% of the time in modern markets, it is the latter. Stop reacting to engineered chaos. If you understand the corporate debt loophole, you stop playing the victim. You stop checking your phone every 10 minutes in a cold sweat. You accept that heavy corporate debt will always create violent volatility in these markets. That is the price of admission. You do not let corporate leverage dictate your personal financial psychology. You learn to read the board like a predator, not like prey. When you see the massive red candles on the chart, you do not look for the sell button. You look for the forced liquidation. You recognize the game being played above your head. You realize that your assets are only truly yours if you have the emotional discipline to hold them when the banks shake the tree. While the crowd panics at engineered volatility, you recognize the pattern. While the 99% sell at a massive loss out of pure fear, you wait with conviction. That is not luck. That is clarity. And clarity is the quiet superpower that separates the leveraged from the free. You are no longer Wall Street's exit liquidity. You are an observer of their game, waiting to capitalize on their manufactured chaos. If you want to master the psychology of wealth, understand the invisible systems that control your money, and stop being manipulated by institutional leverage, subscribe to this channel. The system relies entirely on your ignorance. Choose your game.